Andrew, tell me how financial markets are regulated.
Yeah, man. The Matrix uses two main types of regulation, microprudential and macroprudential.
So, what's the difference?
Well, micro is intended to set standards and supervise financial institutions at the level of the individual firm.
Think of a car and its passengers. Microprudential rules are the seatbelts. They protect the individual institutions from failures if there are sudden jolts or crashes in the system.
What about macroprudential?
It's the regulation intended to mitigate the risk of the whole financial system.
In our case, it is the traffic control system of a city. Traffic lights, signs, and police ensure that accidents, the risks, do not build up in the system and stop it from running smoothly.
Okay then, who does all this stuff in the modern post-2013 British financial system?
There are three top Gs who manage it. Prudential Regulation Authority, PRA, the Financial Policy Committee, FPC, and the Financial Conduct Authority, FCA.
The PRA and the FPC are both decision-making bodies of the Bank of England. The PRA is the microprudential regulator. The FPC is the macroprudential one.
Meanwhile, the FCA is the lonely bozo separate from the B of E, responsible for conduct regulation of financial services firms.
So, what functions do each of them perform?
Imagine them as the three lifeguards of a swimming pool. The PRA ensures individual swimmers are safe.
That's right, Cobra. They maintain the stability of banks, supervise risk management, and set industry standards for conduct and management. For example, they dictate the necessary ratios for capital, liquidity, and reserve requirements.
So, in other words, they make swimmers follow proper rules and give guidance to those struggling to stay afloat.
Absolutely. They have unmatched microprudential perspicacity, just like the FCA.
Yeah, those folks check that everyone is behaving fair and well.
How do they do that?
They are a treasury body that supervise market conduct to ensure legality, combating rigging, for instance. They're as honest as my brothers at Hustlers University. They promote competition so that consumers get better deals and ban financial products that go against the interests of consumers.
Yeah, think of mis-selling and PPI till 2010. Oh, and those loan shark ads. They've banned and changed many of those. You could say they protect new swimmers from being taken advantage of and prevent cheating.
What's left? The macroprudential one?
Yep, the FPC are the lifeguard looking out for the entire pool environment, making sure there isn't a group of swimmers creating large waves in the form of systemic risk. They instruct the PRA and FCA on tackling financial stability issues, as well as advising the government on shocks or bailouts.
Right.
Oh, and they use counter-cyclical capital buffer policies and sectoral capital requirements.
Andrew, no one knows what the hell that last part means. Counter-cyclical buffers are where banks are required to hold additional capital during booms to absorb potential losses, like raising the water level to make swimmers more cautious.
So, sectoral requirements are when risky swimmers, such as banks lending to high-risk firms, are assigned to tougher lanes, forcing them to be more careful and use floaties, i.e. extra capital.
Aight, enough with the pool analogy. Neeks, man, just tell me the other main financial market regulations.
Someone must have gone kicked off social media again. I'll give you another metaphor. Financial regulations are like the fire safety regulations in a building. They protect consumers and the financial system from fires, like financial crises and bad practices.
For example, preventing the sale of unsuitable products to consumers and capping interest rate charges are like having fire-resistant doors. They shield consumers from exploitation and prevent the growth of risky behavior, much like how such doors prevent flames from spreading.
I guess deposit insurance is like having a sprinkler system in the building. If a small fire starts, a bank run for instance, the sprinklers kick in, protecting consumer deposits from being completely wiped out.
Ring fencing commercial banking away from investment banking is like having firewalls between different parts of a building. This way, if the investment branch catches fire, it won't bring down the entire structure, lowering systemic risk.
Some central banks act as lenders of last resort, which is like having a dedicated fire brigade ready to rush in with watery emergency liquidity when a burning breaks out. Their quick response can prevent the whole building from burning down, reducing systemic risk.
Ironically, just like how some building codes can be relaxed to allow more natural light or space, deregulations in finance might also benefit consumers by improving competition, which could lead to better rates for savers and borrowers.